let's start with the fractional reserve banking, because for those who may not know, fractional reserve banking, I talked about it previously, it is this system in which the banks legally are not required to hold on to all of your funds. So you go to the bank, you have, let's just call it, $100,000. You put $100,000 into your bank account. One would think, because you see these numbers on your phone, you see these numbers on your computer screen, you think that you have $100,000 in that account. You don't. There is a IOU of $100,000 in that bank account. But what actually happens is the banks, based on the laws, and this law was actually, rather the reserve requirements were changed in 2020. And I'll just show you that before I go all the way down the rabbit hole. So this here is the federalreserve.gov website, and it tells you right here, and you see how they they put it at the very end. So reserve requirements. For many years, reserve requirements played a central role in the implementation of monetary policy by creating a stable demand for reserves. In January 2019, the FOMC announced its intention to implement monetary policy and an ample reserves regime. Reserve requirements do not play a significant role in this operating framework. In light of the shift to an ample reserve regime, the board has reduced reserve requirement ratios to 0% effective March 26, the beginning of the next reserve maintenance period. This action eliminates reserve requirements for thousands of depository institutions and will help to support lending to households and businesses. Okay, so this here was basically action taken by the Federal Reserve to try to balance out the economic impact of the pandemic, right? Let me just say the coronavirus. I ain't gonna use the word pandemic. So just know, and I just showed you, once again, the sources are below. Look through all this at your leisure. I encourage you to trust but verify that the reserve requirement is literally zero. So for the example, I'll finish using the example of 10%, and then we'll come back around to the 0%. So at a 10% reserve requirement, if you put $100,000 in your bank account, the bank only has to hold on to $10,000. They then take $90,000 and they go and they can basically find other ways to make money off of that capital. And one of the primary ways they do that is by loaning that money out. And so what they can do is take that 90 grand and then give it to somebody as $90,000 of a loan. Now, that person has $90,000. So they have $90,000 in their bank. But guess what? The bank only has to hold on to 10% of their money. So now that bank only has to hold on. And mind you, these could all be clients in the same bank. So now this client, they had $90,000 in the loan that they then got, either directly funded to their account or they moved into this account. And the bank only has to hold $9,000 of their money. So then they take $81,000 and they go lend it out again. And that next person, guess what? The bank only has to hold $8,100. They take the rest, they go loan it back out. And they do this on and on and on. And every time they create a loan, they create new credit in the system, in the monetary system. And so credit is not money, right? Credit basically is transferred debt. And so that's what we were talking about with the Bank of International Settlements, is that ultimately at the back end of all of this, those debts must be squared. Those debts must get settled eventually. But it's this never-ending carousel, and it's like, when do you get off the ride? Because literally, there is more debt in existence than there is money, currency. So even if everybody on planet Earth with a debt said, I want to pay my debt back in full, it's not possible. It literally is not possible. There is not enough money in existence to cover the debt that exists. So some people have referred to this as the debtor slave system, where basically, because there ultimately is not enough money to clear all of the debts, because more debts are created out of thin air, basically, it makes it so that there's always going to be somebody left with the debt. So the antithesis of this would be over-collateralized debt, which is what we see in a lot of decentralized finance applications. And yes, they are working on ways to create a decentralized identity so that they can provide under collateralized loans. But an over collateralized loan is one in which you actually have to put up more capital than the loan that you are getting. So if you want a $10,000 loan, maybe you have to park $20,000 with an institution, and then they allow you access to $10,000. But the benefit of this is that it keeps the system more stable, because it would make it damn near impossible for there to be an insolvency event where the money basically disappears because there's more debt than there is actual underlying value, underlying money, currency. So take everything we just discussed about how the fractional reserve system operates, and now take that understanding that the requirement is not 10%, it's 0%. So they can take 100% of your money that you put in the bank. They can take all of your 100,000 and lend it out. And then the next person, they can take all of that loan and lend it out. And it just creates more and more and more debt. So fractional reserve banking is a threat to your wealth because it erodes the actual underlying value of money, and it actually eats away quite viciously at the purchasing power of the underlying currency. So I have a chart up here. Boom, here we go. So US dollar value measured three different ways. So you have exchange rates, you have treasury notes, you have foreign currency reserves. But the important thing is, I'll bring this back up again, how this purchasing power keeps dwindling down. Mind you, in 2019, there was still a reserve banking requirement. We don't have 2020 on here. So what is the dollar actually worth now? So that is a major threat to your wealth. So point being is, you want to park your wealth in something that is going to beat inflation and maintain its purchasing power or increase. Because over time, as we see, and this is just another article talking about the zero reserve requirement for banks, is basically that over time, you don't want your money that you are either investing as a form of saving, or you're just saving. So a lot of people who've been stacking up, saving money for retirement, right? Well, if you've been saving money for 30 years, if we were to go back to 1990, 30 years ago, where the purchasing power was closer to maybe $2.50, and now, it's far closer. So in 87, this is what $1 could do for you, and then we see what it does for you now. So it's something else. It's something else, and a lot of people don't really understand the gravity. I feel like I've been saying that a lot, but the gravity of sorry, I have to take a moment here. It's just that deep. A lot of people really don't appreciate how fragile this entire financial system is, the traditional financial system. And meanwhile, there's a whole escape route being created, and that's why you're here, because you recognize that and you refuse to go down with the sinking ship. So I'm pleased and happy to be aboard the safe harbor with you.